there have been threats all over the world, primarily while we've been focused on dealing with COVID-19. That are looking at implementing additional taxes under the radar that primarily target the success of American companies. As recently as April 6th, Poland was looking at it. And in late March, both India and Indonesia were talking about this digital services tax. And there's actually a threat in Maryland as well. So I'm excited to have our panelists join us and give us the rundown on this. Andreas Hellmann is the International Advocacy Manager at Americans for Tax Reform, which is a Washington, D.C. based taxpayer advocacy and policy research organization founded in 1985 by Grover Norquist. But Andreas spends lots of time all over the world working with different countries, different groups that are doing different types of taxpayer advocacy. Pieter Cleppe is head of is a non-resident fellow with the Property Rights Alliance and deals with European Union affairs, Brexit, and the Eurozone. He was director of the Brussels Liberty Network, a monthly gathering supporting free market policies in Brussels. He's a columnist for the Daily Telegraph and the Spectator and a frequent commentator in international media. Margaret Mire is State Affairs Manager at Americans for Tax Reform. And prior to joining ATR, Margaret was the policy analyst at the Pelican Institute for Public Policy, a New Orleans-based think tank that's the leading voice for free markets in Louisiana. Her writing and commentary has been published in the American Spectator, Washington Examiner, The Hill, and the Orange County Register, among others. So with that, I am going to kick it off to Andreas to kind of give us a lay of the land and what we're looking at in dealing with these digital services tax. And by the way, I would say if you're out there tweeting, the hashtag is NoNetTax.
Thank you, Katie. Let me start my presentation here. I hope that works. Okay, so everyone should be able to see my presentation now. There you go. So I would like to give a brief summary of what has happened in terms of digital taxation, when it all started, and where we are now. And to do that, I would like to show you a map, and it gives you the global landscape of digital services taxes in 2020. And it shows you where countries would like to introduce one, but are waiting for an OECD agreement globally. And then you can see the red ones is where they already have a digital services tax implemented. And then you see the ones that are slightly less red, more like an orange, and that's where governments publicly announce that they have an intention to implement one. And then you can also see the green ones, where you see that people or countries rejected an implementation. So those are our favorite countries, obviously. And then you can see the ones that are orange, they drafted legislation, but they haven't implemented it yet. And then the blue ones, they have no development. So as you can see from the map, there's quite a lot of countries that are either working on those proposals or already have them implemented. And so I would like to walk back a little bit and tell you when it all started. It started with the European Union when they introduced their first DST proposal in 2018. And the reason they introduced it was that they claimed that there's a mismatch between where profits are currently taxed and how certain digital activities create value. And so the European Commission claimed at the time that tech companies, and we have to say here mainly American tech companies, would not pay their fair share. We'll later see what is the fair share, what is actually fair, and is it true what they claim. So they proposed a 3% tax that would apply to companies with both total annual worldwide revenue of 750 million euro, which is around $860 million, and EU revenues of 50 million. And there was there were another couple of aspects in this proposal that would basically only apply to make sure that the tax would only apply to American tech companies, and not to any European-based companies. So it's a very targeted tax. So the DST would be a turnover tax and would be imposed by individual countries at a rate of 3%. On revenues derived from the selling of advertising space, digital activities, online marketplaces, and sales of user data. And so the European Commission calculated that the 3% tax, if it would be implemented, would generate 5 billion in revenue per year, which is a lot. So the key arguments, and they stay all the same. It doesn't matter if it's implemented by the European Union or by Germany, France, or Poland, or Austria. At the end of the day, the consumer will pay the tax because companies will likely be able to pass the tax on to consumers. We saw an example from Amazon in France right after the tax was proposed and implemented and voted on. Amazon France changed their user fees because they have to somehow pay for this tax. But not only that, the tax also poses unprecedented dangers to tax competition, to innovation, and of course to European and worldwide economic growth. And the new tax also represents a dramatic and irreversible shift for the international tax system and does damage the transatlantic relationship and will likely lead to a spiral of retaliation. We can see that. We can talk about this a little bit later when we look at the negotiations between the U.S. and France. There were quite some tense moments going on, and it really did not help the transatlantic relationship that the European countries are trying to tax our tech companies. Also, this tax will likely result in double taxation and result in less innovation and negative economic growth. So the main question, and that's the claim that the European Commission made, was that they're not paying their fair share. So I always like to start by a look at the numbers. So our partner organization, ESIPE in Brussels, did a great study on this with Dr. Matthias Bauer, and they just compared the effective corporate tax rates of US-based digital corporations to the average effective corporate tax rates of large EU-based companies. And then if you can see, for example, if you just go through the numbers, you can see, for example, that the effective corporate tax rates from Alphabet, if you compare it to the average of Germany, for example, is way higher. Same with Microsoft, if you compare it to France, for example. And on the next slide, you can see the average effective corporate tax rates of selected companies that are headquartered in Western EU member states versus large US-based digital companies. And that's even more clear if you look at Alphabet again, and you compare that to Volkswagen, for example. You compare it to Deutsche Telekom or Deutsche Post. Those rates are all lower. So they're not only paying their fair share, they're paying more than that. And that's really important to know, to just get rid of this myth that somehow they're not paying their fair share. So the European Union proposals could not be implemented at the EU level, thank God, because there was no unanimous support from all EU member states. There were a couple of EU member states that were really against that tax. One of them was Ireland, the Nordic countries, and also Germany really didn't like that tax. But unfortunately, there were countries like France and others that really were relying on the revenue from that tax, because it's basically the way that they see it. It's free money up for grabs. You can tax other people that can't vote, or better say, against you. So shortly after this proposal failed on the EU level, countries like France, the UK, Italy, Spain, and Czech Republic were pushing ahead with their own plans for digital services tax. And so France was actually the first country in setting up a 3% tax. And the tax was set out to generate around, let's see, on the next slide, that should be the number. So after France passed the law and implemented the tax, U.S. President Donald Trump asked the U.S. Trade Representative to launch a Section 301 investigation, and the investigation concluded and says that the tax indeed discriminates and is unusually burdensome for U.S. companies, and that's when the trade war and the whole negotiations started between the U.S. and France, because then they proposed to implement tariffs on French luxury goods, and that would really badly hurt the French economy. So that's when they finally came to an agreement and said, okay, we will hold off on the tax and we will not implement it until the end of the year, and hopefully we can reach an agreement by then. Another update is really important because that was the highest DST rate in the European Union, comes from the Czech Republic. And so they, in November 2019, they approved a 7% digital tax. So that's way higher than the usual 3 or 4% that we see in other countries. And the Czech Finance Ministry estimated the tax would raise around 3.8 billion crowns, which is $150 million. And so this is really important that we look at this number because it's the highest number in the European Union. The good news is that in February 2020, the Budget Committee of the Czech Parliament started the second reading. And yes, they moved the measure closer to implementation, but there's also a lot of opposition that wants the rate to go lower, more to 3% or even 2%. So I'm going to go to Poland real quick since my time's running out. So on April 6th, the Polish government suggested again a new digital tax to American tech companies. And they did this under the cover of fighting COVID-19. This is really new because we see now a couple of countries like Indonesia and India that they're all implementing their digital taxes under the cover of COVID-19, and they say we need this money to support our economy, we need this money to support our healthcare sector. In regards to Poland, it's very sad because they were on a really good track, especially after the visit of U.S. Vice President Mike Pence in September 2019, when the Polish government ditched the plans for the tax, and they were on a good track. And now they're walking back and they're thinking about implementing it again. So I'm going to stop here and hand it back to Katie.
Great. Thanks so much, Andreas. I will kick it over to Margaret. Do you have your presentation up and ready?
Andreas is going to help me out with this.
Yeah, hold on. I'm just going to load it in.
So thanks so much, Andreas. Margaret is going to give us a little bit of the state view, kind of things that are going here, and then we're going to kick it over to Pieter to sort of wrap it up and a lot of the perspective from the European Union, what folks are thinking there, why this is the sort of thing that is popular. All right, I've got this ready to go here. Again, you can send in your questions in the comment section on YouTube. You can tweet those questions at us with the hashtag NoNetTax, or at me, I'm at Digital Liberty. Happy to take questions at the end of this. Okay.
Thanks, Katie. So I'm just going to take a couple of minutes to discuss the digital advertising tax in Maryland that was recently approved by the legislature, despite some strong opposition. I'll start just with talking a little bit about what the tax does, then I'll highlight some of its many flaws, and then I'll conclude with an update on where things stand in Maryland and the rest of the country for that matter. So basically, the Maryland digital advertising tax, which is House Bill 732, in the event anyone wants to look it up, basically imposes a new gross revenue tax on digital advertising services in Maryland. All companies that do at least $1 million or more from digital advertising services in Maryland and have $100 million or more in global gross revenue are subject to the tax. The tax has 4 brackets that are based on companies' global gross revenue. The rates will range from 2.5% to 10%. And I just want to quickly highlight the first flaw there, which is a company could have a very large global gross revenue, but then when their expenses are taken out, their profit could actually be much smaller. And so the situation there could end up with a company that doesn't have a massive profit still paying a massive 10% tax rate. So that's the first flaw, but there are many more which I'll walk through now. And the first one is proponents of this bill have been saying it is a tax on large digital advertising companies. While it might be a headache for those companies, the reality is the costs associated with the tax and the related compliance costs are ultimately going to be passed on to Maryland businesses who do digital advertising. Those companies may decide that they no longer can afford to use digital advertising, and that could hurt their customer base since they can't get word out. They might pass the cost on to consumers by raising prices. They might have less money to invest in jobs and wages. So while it may be collected from digital advertising companies, it's certainly going to hurt Maryland businesses and consumers. Another concern that many people have pointed out is that it is likely to result in taxpayers footing the bill for costly legal challenges that the bill probably won't survive. The big one that comes to mind is the Internet Tax Freedom Act, which was made permanent by President Obama in 2016, which basically says tax policy can't single out e-commerce. This bill clearly does that, and even Maryland's own Attorney General has acknowledged that defending the bill against such charges, they would have a very, very weak case there. Another concern that a lot of legal experts have pointed out is that it also likely violates the Dormant Commerce Clause, which basically prohibits discrimination against interstate commerce or unduly burdening interstate commerce. While the bill doesn't say that exactly, the threshold for the tax to kick in would effectively have that outcome. So that's a concern that many have pointed out. Which brings me to my next point, and that is basically every argument, and I'm sure Andreas and Pieter will want to elaborate on this point as well when we're done, but basically every argument that the US has been making against digital service taxes in other countries, California can make against Maryland's tax. Right now, digital service taxes are a major point in ongoing trade negotiations, and it's very difficult for us to oppose those in other countries when we have them right here. So anyway, that's a big concern. And then finally, I will point out the fact that this bill is very vague and complicated. In some instances, what digital advertising is might be clear, but there's some other areas where it's not very clear, and the bill doesn't clarify exactly what the definition of digital advertising is. And finally, too, with the use of like VPNs and ad blockers, it's hard to say what would count towards the calculation. So it's just got some very unclear language in it. And then finally, so where things stand. So like I mentioned, the legislature passed the bill a couple of weeks back. Governor Hogan is expected to veto it, but I believe the bill passed with veto-proof majority, so there is a chance that the legislature tries to override it. If that happens, I'm sure it will be met with legal challenges very quickly. And then as far as where the rest of the country is, New York and Nebraska have introduced similar digital advertising tax proposals, but to date, no state has imposed such a tax. So with that, I'll hand it back over to Katie.
Great, thanks so much, Margaret. That was a good summary of kind of what's going on there and what's happening in the US and kind of how we might be undermining ourselves a little bit when states are just focused on where they can raise taxes. With that, I'm going to kick it over to Pieter.
Thank you, Katie, and thank you for the invitation. So I think Andreas covered quite a bit when it comes to Europe. So what I could add is that this patchwork of national digital services taxes may actually undermine the European single market. It may become harder for businesses to do business cross-border. So that's a concern, basically protectionism rising between European countries as a result of this. However, on top of it, it is also it may also lead to protectionism versus non-European competitors. This was at the heart in the conflict between the French President Macron and US President Trump, with Trump ultimately winning. as France has sort of frozen its digital services tax until the end of the year. I mean, if you look into that digital services tax in France, it's actually quite concerning. Not only is it's quite a bit wider its scope than in other countries, but also it was gonna be retroactive taxation. Now, you can be in favor or against taxes, but it's a very bad policy to have retroactive taxation, that stuff is being taxed that was not known to be tax liable at the time. So that's actually quite worrying. So yeah, what else is there? Of course, I mean, there's the issue that this may fundamentally further undermine efforts to create a European digital industry. You may know or not that the European Union had this so-called Europe 2020 plan, which was another grand scheme, grand plan to become a very competitive economy by the year 2020. Now we are in 2020, and that ambition appears to have disappeared. On the contrary, now the efforts are towards creating all kinds of taxes imposed specifically on the digital services sector. Again, in France, one of the projections was that this digital services tax in France would only hit one French company, whereas it would hit many big American digital services companies. This is testament to the sad weakness of Europe's digital services industry. Now, I'm not so pessimistic for the future. It's not because Europe had it wrong in the past that we will continue to have it wrong. But of course, this kind of treatment of, let's say, the most innovative sector in the economy is not exactly welcome if you want to support innovation. Perhaps an optimistic thing is that the United Kingdom may have a change of heart. The government has suggested it may abandon its plans for a digital services tax if indeed in return there would be a trade deal with the United States. Now, of course, this brings us back into the whole the Brexit discussion, where it is not clear to what extent the US and the UK can free up trade between each other when the UK has not for 100% secured an independent trade policy. Because as you may know, the United Kingdom may be legally outside of the EU, but practically it's still outsourcing its trade policy to Brussels, its regulatory policy to Brussels. So I'm afraid first the UK will have to negotiate how to entangle itself from the EU regulatory and trade machine before it is able to conclude a trade deal with the US, which would then also have as a part that the United Kingdom would not introduce such a innovation destroying digital services tax. Maybe last but not least, I found interesting to go through a comment by a think tank here in Brussels, the CEPS think tank, the Center for European Policy Studies. Now, what they did is they listed 5 criteria for a digital services tax to be optimal. And the interesting thing is that if you look at these 5 criteria, you have to conclude it's very hard to fulfill them, meaning the conclusion should be it's probably not a good idea to have such a digital services tax at all. Now, the first criteria is avoid unnecessary increases in compliance costs. Now, if you look at every proposal, I mean, it's evident. It's very hard to to make it easy for businesses to comply. For example, what is digital advertising? What is not digital advertising? Secondly, adopt proportionate rules to avoid harming SMEs and startups. Again, if you're an SME or a startup, you simply don't have the manpower, you don't have the resources to comply with all of this. So that's definitely another hurdle for these small businesses to compete with big business. Thirdly, promote legal and regulatory certainty. I mean, I probably don't have to explain it. If you listen, if you look at everything that's been proposed, I mean, uncertainty is all around. Then fourthly, stay away from concealed state aid. again, the fact that in one version of the French digital services tax, only one French company would actually have to pay the tax, and so many American companies. I mean, that makes it clear this is all about state aid. This is all about protectionism, and actually has little to do with the real motivations that are being given. And as Andreas also mentioned, the ESARP study, if you look at the effective corporate tax rate, you see that old industry in Europe, big industry, has been well connected and has made sure that their effective corporate tax rate is actually not that high, whereas SMEs pay a lot more taxes, which is unfair. So add to that digital services tax, this would only make it worse. Then last but not least, also quite important, mitigate the impact on small countries if you want to do it in an optimal manner. Well, in Europe, we have countries like Ireland, countries like Luxembourg that are host to the likes of eBay, Luxembourg, or Google, Ireland. Now, if you impose these taxes, these small countries will actually lose a competitive advantage. And this will actually be on top of, and there I conclude, another change that was recently made in recent years in Europe when it comes to VAT income. Also there, the European Union has imposed new rules for businesses. So basically, what's now mandatory is that if you sell cross-border, you have to keep a long list of your customers. So then to be able to prove where you have to pay the VAT. Now, everybody who has ever done business in Europe cross-border, I think will agree that VAT is just a monstrous piece of legislation. It's incredibly hard to even know when you have to pay it, when you don't have to pay it. Legal uncertainty is very high. So, I mean, if indeed the DST becomes a second like a second episode of what we've seen with the change in VAT rules, then this is going to lead to less cross-border trade in Europe, and that's exactly the opposite of what we needed. We need to make use of the fact that Europe has so many customers, and we need to scrap these internal barriers to trade, not create new ones. So I'll leave it there, and I'll happily take any questions.
Great, thanks so much, Pieter. Over in the comment section, I did see there was one question for Andreas, and Pieter, perhaps you want to follow up on this too, about how does value creation play a role in the European viewpoint on digital services taxes?
Yeah, thank you, Katie. I think that's a great question. So in my presentation, I said that this will do a lot of changes, bring a lot of changes to the way we tax internationally, and value creation is a big part of that. So usually what happens is, if you take the example of a car manufacturer, let's say BMW, they manufacture the car in Germany and they ship it to other countries where people drive the car and like the car. Then this company will still get taxed in Germany because the value has been created there. And with the digital services tax, this concept changes because the value, if you take that principle away, then the value is being created when the user uses the app or uses the digital service. And you can compare that to, like, my favorite example, which is the French winemaker. If you buy a bottle of wine, where do you think the value has been created? When you drink the wine, when you open the bottle and enjoy the wine on your couch, is that when the value has been created? Or is the value created in France, where the French winemaker uses all of his experience and knowledge to make the best wine possible and then sell it to customers around the world? So this is where you can see that if you violate those long-standing principles, it does great damage, not only to other products, but to the whole way we tax internationally. And it might come back to us, because if we come up with those user taxes or we change value creation, who says that countries that are not our friends, like China, imposes a tax on people that drive certain cars because it's the user car, because they say the value is created when you drive the car in our streets?
Thanks, Andreas. And we've got another question, comment. It says, here we go. What is the international... Oh, okay. If only 33 states decide to tax revenue at 3%, then there would be no revenue. So one of the many unprecedented proposals in the European digital services tax is to tax revenue. So then that follows up on if only 33 states decide to tax revenue at 3%, then there would be no revenue. Pieter, did you want to comment on that?
Can you repeat? I didn't quite catch it.
So one of the many unprecedented proposals in the European Union proposals on digital services tax is to tax revenue.
Okay. Well, I think that ties into what you can hear me. What Andreas was saying, that I mean, if you sort of change the way change the way of taxing and change the calculation, then you sort of undermine the whole international system. Indeed, if China does it for their own purposes and uses it for some other agenda, then this may badly backfire. I mean, I'm of the opinion that if the government wants income, that the most ideal tax is simply a tax that is closely linked to the specific services provided by that government. So that also makes it harder for a government to use resources for any other purpose that they would like. Because if they, for example, impose a tax for healthcare, then they can't use that money for, I don't know, like building the roads or something. So that's sort of my ideal tax retribution. And I think indeed this proposal of sort of changing the way in which is calculated in order to impose a tax goes away from that ideal. It creates more uncertainty. It goes more in the direction of a tax system where the government that will decides how to tax in a very complex way, and this actually will reduce the scope for civil society to scrutinize also what happens with all these resources.
Great, thanks. Andreas or Margaret, did you want to follow up on that?
Yeah, I can. I would like to follow up just really quickly. Yeah, the question is actually really funny. You're right. If more and more people tax revenue, there might not be revenue left to tax. That's correct. But that shows that there is no real principle behind that tax. It's literally just the greed from certain countries that say, you know, we're not as good in that part of the industry than the US or other countries, and that's why we just tax it, because we you know, if we would participate in that part of the industry, we wouldn't tax it the same way. We wouldn't hurt ourselves. So you can see the same way France reacted when we said, okay, we would like to impose tariffs on your luxury goods. This is basically the only industry that they have that they're successful at, because no one wants to drive their cars, no one wants to buy them, and maybe there's a little bit of tourism, but the French luxury goods, that's the big industry they have. So they could make, they were basically making the same argument by saying, leave us alone, leave our industry alone that we make. But for some reason, they came up with this alternative narrative of, you know, this is just the right thing to do. It's fair. And so we all have to do it. And that also has a lot to do with privacy concerns of European citizens. So a lot of governments just, you know, tell people, you know, they violated, in some cases, your privacy and our privacy laws, and now they're not even paying their fair share. You know, both things are not true, but it plays into this narrative, so that's why people also support it. And the same with tax and revenue. It doesn't make any sense. It is deeply unfair. It's discriminatory, and we should do everything we can to stop it, especially because they're using the same arguments that we use for their own industry to protect their industry.
Great, thanks for that. And you know, there's something that's very similar in the U.S. I would say that Senators John Thune and Ron Wyden foresaw this problem coming. They've been reintroducing over a number of Congresses the Digital Goods and Services Tax Fairness Act, and the most recent reintroduction, you know, this is to protect innovative digital goods and services from multiple and discriminatory taxes. So one aspect of that bill is that you can't tax digital goods or goods sold online differently than you would tax tangible goods sold in the store. And if it's not taxed in the physical world, it can't be taxed in the digital world. The other thing that they do with this bill is they set up a structure that prevents multiple states from taxing the same transaction or the same item, which I think is really the problem that we run into with the way the European Union countries are approaching this, is that, you know, as the commenter said, you know, you get 33 different countries taxing, then you end up with no revenue. So if every single state can tax a digital transaction or a service such as cloud computing, texting, emailing, anything like that, and you think about all the different ways that those services get to you. So if I'm using my phone, I might download a song or a game from a company that's based in Kansas, but I'm driving through Texas, but my address is in Virginia, you know, those sorts of things. We wonder which states have taxing power. And that's something that needs to be set very clearly. It's a bill that's been in front of Congress for a number of sessions now, and becomes even more important when we look at what's going on in Maryland and the possibility that we might end up with the same kind of tax in other places. Margaret, I think you mentioned New York and Nebraska were looking at this. Oh, let me unmute you real quick. Oh. Okay.
Can you hear me? Yes, they've looked at similar efforts to tax digital advertising. Whether or not they'll move forward, we'll find out. And I also think too, now that states are looking at deficits, you know, in response to COVID-19, it is possible that they try this in other places. I mean, hopefully not, because the reality is, you know, it's going to hurt local small businesses in their states who are already hurting. It's going to hurt consumers who are already hurting. But yeah, we'll see what happens over the next couple of months.
I think COVID has really brought into stark reality how important the digital world is, and that governments, rather than trying to, our government should make it easier for people to use the internet, to use digital services, to access things. Telemedicine has been a big conversation topic, where we've got government regulations in the way of folks being able to use those applications, or dealing with cross-border issues with that as well. So really looking at the different world and making it easier for those types of things to move faster. Again, the Digital Goods and Services Tax Fairness Act is very important. It's introduced in both the House and the Senate. It's always been bipartisan. More than ever, as we're confronting these issues internationally and here at home, that's something that we need to take into account as to how we should protect these things from taxes, kind of like we did with the Internet Tax Freedom Forever Act, which was passed back in 2016 and prevents 2016 and prevents taxes on internet access, so that those of us sitting at home don't have to pay taxes in addition to any surcharges or fees that are on our internet access. And that helps more people connect to the internet and stay connected. There were about 6 states that were grandfathered in, because before the initial internet tax moratorium was passed in 1998, there were 6 states who already had internet taxes on the books. Now, this year in July, those states are grandfathering out those taxes. And that's very fortunate, especially since everyone sitting at home is relying on the internet. And fortunately for those states, collectively, all 6 of them, that only accounts for about 6% of their 2% of their tax collection. So it's not that big of a deal for them, and it definitely helps make the economy run smoother, more effectively, and is certainly important for internet freedom and people having access to the internet services that they need. So with that, I am going to ask if you guys have any closing comments that you'd like to add to this, and then we will wrap it up.
Yeah, maybe I can start real quick. First of all, thank you everyone for watching this. It was our first time that we're doing this. We hope to do it again soon. There's a lot of other topics that we'd like to cover. One thing I would like to mention, or two things actually. Number one is now is just the worst time during this COVID-19 outbreak to impose DSTs, because it will do a lot of harm to innovation and to consumers. And now is the time that they rely on those services, and they need them more than ever before. So don't make it more expensive. Don't tax them. That's not the right thing to do right now. And secondly, I would like to say that this is just part of a general strategy of the European Union to kind of create a safe zone for their own digital companies to be more competitive. They tried, in the first place, they tried to give massive government subsidies to their own companies. They still couldn't compete. Then they tried to tax American tech companies to help them compete. Also didn't work. And now, and maybe we could do this on another day, talk about the EU digital strategy. Now they're coming around with more regulation and antitrust reform to effectively ban American tech companies from market access. So again, those two things together, this is not the time to do it. People are heavily relying on tech services, and tech companies are doing a great share and a great deal to help fight this crisis. So let's all fight together against those efforts of those countries. Thank you.
Any other comments from our panelists?
Yeah, maybe quickly. So I agree with Andreas, of course. I mean, listening to all the arguments and looking at it, I think the conclusion you have to draw is that, I mean, it's something unsustainable. I personally think that it will be very hard to implement. You very quickly end up in tit for tat games like between France and the United States. But yeah, thank you for setting this up to basically make the case against it. Yeah, let's hope that this has been a contribution to that.
And Margaret.
Yeah, I would just emphasize that, you know, like Andreas just mentioned as well in his concluding remarks, this ultimately will hurt small and local businesses a great deal. It will hurt taxpayers. It will hurt people who have already been having a difficult time. So, you know, it's always a bad idea. There are a lot of flaws with the Maryland digital advertising tax and similar proposals in other states. It's never going to be a good decision, and particularly not now.
Great. Well, I want to thank you all so much for participating in this discussion. This will be recorded and saved. So if anyone wants to go back and sort of go over what some of our panelists have talked about, this will be available on the Americans for Tax Reform YouTube channel. Thank you guys so much, and really appreciate you joining us.
Thank you.
Thank you.